This is a podcast from the Business Times.
Welcome to the BT Mark to Market podcast. My name is benpaul, and I'm a senior correspondent at the Business Times. This series of podcasts, which is based on my weekly column in the Business Times, aims to provide analysis and insight on market trends and corporate issues in Singapore. We're in the month of September 2024, and we could be just days away from the US Federal Reserve finally delivering its first rate cut. The market has been anticipating a cut since the beginning of this year, but it wasn't until the last couple of months that a consensus seemed to emerge among Fed officials that it is appropriate to begin loosening monetary policy. Fed Chairman Jerome Powell clearly articulated this last month during his speech at the Kansas City Fed's annual conference in Jackson Hole when he said the time has come for policy to adjust. My view is that this will be positive for markets across Asia. Other major central banks in the West that are already loosening monetary policy include the European Central Bank, the Swiss National Bank, and Bank of England. If the Fed joins in, it would take pressure off Asian currencies and facilitate a broader loosening of monetary policy in this region that would likely support economic growth and asset prices. For investors in Singapore, this could be the moment to begin increasing exposure to some of the larger Singapore-listed real estate investment trusts, or Reits. Now, I will talk about investing in REITs later in this podcast, but let me first talk about what Fed rate cuts could mean for the markets in general. It's often said that interest rates are like gravity in financial markets. When they're high, they weigh everything down, and when they're low, they lift everything up. But the reality is more complicated. When the Fed began raising interest rates aggressively in 2022, the S&P 500 did come under pressure. At the end of 2022, that benchmark index was more than 19% lower than where it was at the beginning of the year. Now, even though the federal funds rate continued rising in 2023 and has remained higher in 2023 and 2024 than it was in 2022, the S&P 500 actually rebounded and climbed strongly. The S&P 500 is now nearly 16% higher than it was at the beginning of 2022, before interest rates began rising. So, if the Fed begins cutting rates now, should we expect the S&P 500 to rise even further? Here's what I think is going on. We're at the tail end of a rather unusual economic cycle. I've talked about this before. The COVID-19 pandemic created a demand shock as well as a supply shock for the global economy. On the one hand, millions of people around the world were suddenly forced to stay at home and accumulate savings. On the other hand, millions of people around the world were also suddenly unable to go to work, which caused global supply chains to break down. When the pandemic restrictions were lifted, inflation took off very quickly as pent-up demand collided with supply chain bottlenecks and weak labor force participation rates. Since then, there's been a gradual reversal of those pandemic-related distortions to demand and supply. In particular, the supply chain bottlenecks have eased, and US labor force participation rates have improved. This resulted in stronger than expected growth and lower inflation. The way I see it, that robust macroeconomic backdrop through 2022 and 2023 supported US corporate earnings and the S&P 500, despite higher interest rates. The reason the Fed is now expected to cut rates is that there are clear signs inflation is no longer a risk and that the US economy might be slowing. In fact, markets across the world suffered an unnerving rout last month following signs of weakness in the US labor market, as well as concerns about pockets of overvaluation in some sectors. There was another bout of volatility just before the recording of this podcast too, which took a toll on some of the high-flying names in the chip sector. My takeaway from all of this is that interest rates are an important factor for the market, but they're not the only factor. The macroeconomic backdrop and corporate earnings are also very important. And if you're a long-term investor, stock valuations are crucial too. Last month, after more than 90% of S&P 500 companies had reported their second quarter numbers, FactSet said in a report that 79% of them had delivered a positive earnings per share surprise, and 60% of them reported a positive revenue surprise. FactSet also said earnings growth for these S&P 500 companies in the second quarter came in at 10.9%, which was the highest year-on-year earnings growth rate reported by the index since the fourth quarter of 2021. So companies are broadly performing well. Valuation-wise, the S&P 500 is trading at about 21 times forward earnings. This is above the 5-year average of 19.4 times, as well as the 10-year average of 17.9 times. So US stocks are not dirt cheap, but they're not too richly priced either. There are some risks ahead though. FactSet said more companies mentioned the word recession during their second quarter earnings calls versus the first quarter. Also, not surprisingly, a lot more companies mentioned the word election during their earnings calls. The context in which that word was mentioned related most frequently to energy and carbon emissions, the Inflation Reduction Act, and tariffs and trade. The bottom line here, in my view, is that the Fed rate cuts are coming at just the right time to support economic activity and the market. Against the backdrop of lower interest rates and the heightened risk-taking that is likely to bring, there could well be increased liquidity flows from developed markets to Asia as investors look for better returns. The main ASEAN economies are widely viewed to be beneficiaries of increased US-China trade frictions. Singapore will probably get its fair share of those investment flows. One key segment of this market that seems poised to benefit from these flows, as well as the rate-cutting theme, are Reits, which I'm going to talk about next.
Partnering you on your wealth and investment journey.
Bringing you insights to make well-timed market moves.
Sharing actionable personal financial tips.
Helping you protect and grow your wealth.
Analyzing Singapore's market trends and corporate issues.
Supporting you through your Singapore property journey.
Insights from your trusted partner, the Business Times podcasts. Are you listening?
And now, back to Mark-to-Market from the Business Times.
Since the beginning of 2022, the year that central banks began aggressively tightening monetary policy, the whole REIT sector in Singapore has struggled with soaring debt costs and concerns about deflating asset valuations. Even with all the recent excitement about the Fed being poised to cut rates, the iEdge S-REIT index has chalked up a negative total return of 6.5% since the beginning of 2022. The Straits Times Index, on the other hand, has delivered a positive total return of nearly 27% during the same period. There has been a wide variation of performance among the components of the S-REIT index, of course. The best performer since the beginning of 2022 was Far East Hospitality Trust, with a total positive return of nearly 30%. The worst performer was Manulife US REIT, with a negative total return of 82.4%. Obviously, there were idiosyncratic factors behind the performance of these two outliers. Yet, even among the 7 REITs that are currently components of the STI, performance has not been great since the beginning of 2022. The best performer among these relatively large and widely followed REITs was Fraser's Centrepoint Trust, with a total return of 16.8%, which is well short of the STI's total return for the same period. CapitaLand Integrated Commercial Trust was not far behind, with a total return of 15.3%. CapitaLand Ascendas REIT had a total return of 14.7%. All the other REITs within the STI had single-digit or negative total returns during the period. Even if we zoom in to a more recent time frame, Singapore REITs are still clearly facing strong headwinds. Since the beginning of this year, for instance, when it was already clear the Fed would not raise rates any further, the S-REIT index recorded a negative total return of 0.4%. The STI, on the other hand, achieved a positive total return of nearly 12%. To me, what this suggests is, firstly, that it's not too late to begin investing in Singapore REITs in anticipation of lower interest rates, but also that investors should tread carefully and not assume that monetary policy loosening by the Fed and other major central banks will immediately translate to lower funding costs and higher distributions per unit for every Singapore REIT. In fact, it's possible that some REITs will experience higher overall debt costs even as interest rates begin falling. Keep in mind that at the beginning of 2022, the target range for the federal funds rate was between 0 and 0.25%. The target range is now between 5.25% and 5.5%. The 10-year US Treasury bond yield was about 1.5% at the beginning of 2022 versus about 3.7% currently. Given the very rapid and steep rise in interest rates since 2022, some REITs may still be refinancing their maturing loans at higher rates in the months ahead. DBS Group Research said in a report last month that some Singapore REITs might not benefit from a reversal in overall financing costs until 2026, based on the assumption of a 100 basis point reduction in benchmark rates in 2025. Of course, falling interest rates will have a more immediate positive impact on REITs with a relatively small proportion of their loans tied to fixed rates. DBS said in its report last month, these would include names such as CDL Hospitality Trust, Far East Hospitality Trust, Suntec REIT, OUE REIT, and Lend-Lease Global Commercial REIT. Investors should also be careful to not lose sight of the underlying fundamentals of each individual REIT as they try to ride the tailwind of easing interest rates. The demand and supply dynamics of REITs in the hospitality sector, for instance, are quite different from REITs that own offices or shopping malls or industrial properties. And different analysts are going to have their own views on which sectors and which individual REITs are most attractive. For what it's worth, DBS said in its report last month that it was most positive on the outlook for REITs in the retail property space, because retail properties are seeing stronger than expected rental reversions, and there is little new supply coming through. On the other hand, DBS is not excited about hospitality REITs, as the outlook for hotels is currently marred by a burst of new supply, as well as budget wariness among tourists. Perhaps the most important thing for investors to keep in mind about REITs is why they exist in the first place. The biggest REITs listed in Singapore function as real estate securitization platforms for major real estate developers. Stabilized properties are regularly injected into these REITs by their sponsor groups. The REITs in turn tap their unit holders and lenders for cash to acquire these properties. If it's done right, the acquisition of new properties can have an immediate positive effect on a REIT's DPU. So the sponsor group gets mature properties off its books, the REIT manager, which is owned by the sponsor, has a larger property portfolio to manage, and unit holders of the REIT benefit from a higher DPU. But a lot really depends on the price at which the properties are acquired and the terms at which the REIT manages to raise the funds. Just before this podcast recording, CapitaLand Integrated Commercial Trust, which is the biggest of all the REITs in the Singapore market, unveiled plans to acquire a 50% interest in Ion Orchard from its sponsor, CapitaLand Investment, at an agreed valuation of more than $1.8 billion. CICT has announced an equity fundraising exercise to come up with more than $1.1 billion for the acquisition. So far, it has raised more than $350 million from a private placement of nearly 172 million new units, priced at $2.04 each. This was at the bottom end of the pricing range it had indicated, and a 4.4% discount to the volume-weighted average price of its units the previous market day. CICT is now preparing to sell a further 377 million new units in a preferential offering at just over $2 per unit. Not surprisingly, the market price of CICT's units has dropped since the transaction was announced. It closed at $2.06 just before this podcast recording. REITs are often presented as income-oriented investments. This is not exactly true. They are designed to deliver the bulk of their total return through regular cash distributions, but they also regularly raise equity to expand their property portfolios. As interest rates gradually fall and market sentiment turns more positive on Singapore REITs, investors should be prepared for a surge in such acquisitions and fundraising exercises. That's it for this episode of Mark to Market. I'm senior correspondent benpaul at the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.